Robert Kiyosaki said, taxing the rich, it'll never happen. And let me tell you something. Rich Dad, Poor Dad is like a Bible. So I'm gonna go and let's break down exactly what he meant by that, what types of income have what tax rate, and how you can avoid tens of thousands of dollars in taxes alone. Your tax BFF has your back. Let's talk more about what you want to talk about next. Like, comment, and subscribe. See you soon. So yesterday I remixed a video with Robert Kiyosaki, which we'll talk a little bit about in a minute. And it's doing numbers. So I'm like, let's jump on live. Let's really dive deep into this. I see I have a bunch of new followers. So of course, I wanted to start this video just by introducing myself. A lot of new followers. A lot of you guys are really interested in the content that I just recently shared about the 3 types of income. And I have been a tax professional since I was 21 years old. I have owned tax team services since 2014. We're coming up on 10 years. It's a full service tax and accounting firm where I focus primarily on business taxes. I have a coaching program that I do for small business owners that are making more than 30,000, leaning towards 100,000 and more, that just want to figure out the ins and outs of running a business, how to run it, how to pay themselves, how to pay their employees, how to avoid taxes, all of that good stuff. And we wrap it up into some bite-sized pieces and make sure you got some plug and play so it's not taking up too much of your time. I digress. Let's jump right into this thing. So, Robert Kiyosaki wrote Rich Dad, Poor Dad. And of course, 50 million other things, and has been doing speaking engagements and tours, and it's just the bomb when it comes to financial literacy, as well as talking about rich versus poor. One of the things that I focus so much on in my coaching program is mentality. A lot of us grew up with money don't grow on trees. I'm borrowing from Peter to pay Paul. All of those different sayings, those are things that stick with us that we don't even realize. And it really affects our mentality about money. So Robert Kiyosaki, he was like, one of the things that really stood out to me was we always talk about tax the rich. And he said that'll never happen. Ooh, I said, ooh, we got one. We got one. And that mentality and that understanding of taxes is what we're going to talk about today. Because number one, there are 3 types of income, which he pointed out in the video that I just posted yesterday. And those 3 types of income are earnings. So your W-2, your wages, how much money you are making from working. Then you got capital gains. Capital gains are any assets that you have and you sell. So if you're buying and selling homes, if you're buying and selling stocks, if you have equity partnerships in different things, and then you sell them off completely, you will have capital gains tax rates. And when we get into this, I'm going to be talking about long term because there are significant changes in taxes for short term versus long term. So if you're in a business of buying and selling stocks, I forgot what they call them, day traders. Yeah, you guys, you're paying earnings taxes on any gains that you have. You are not falling a part of this tax break that I'm going to be talking about. And then you got your passive income, the income that you make while you sleep. You don't materially participate in this income generation. For me, that is my book, Success Failed Me. That book sells, I don't do anything. I put the work in, I wrote the book, I got it edited, and I published it, and boom. If you buy it, it gets shipped to you, and I make a couple dollars, like passive income. Let's dig into this really quickly. And I want to, let's back it up. Rich Dad, Poor Dad. If you have not read it, you have to, period. Let's start there. All of the millionaires, you'll hear so many millionaires and billionaires talking about that this being on their shelves. It has sold more than 40 million copies. It is the bomb. And basically the premise is the educated dad versus the never graduated, didn't even go to high school dad, the successful two successful guys making money, but one is always in some type of financial turmoil. The other one is successfully growing his business and making sure that he's leaving things and assets to his family as he dies. The mentality of work for money versus money working for you. All of these things are addressed in this book, and it is incredible. And I wanted to take a deeper dive into this because one of the things that has been like a trending topic over the years with Robert Kiyosaki is, did he actually have a rich dad and a poor dad? Or did he just want to reach us where we are and where we have generated our idea of money and success by looking at our parents and kind of speak to us? I don't care if he had one or not. This is a good story, and it gave me so much content. So let's start from a tax perspective. Earnings. I'm going to start with a higher earner. We're going to use the number 450,000. 450,000 is a phase out number for a lot of different tax rates and tax laws. So I don't want to go above that because I'll be talking to a whole different person. But I'm talking about somebody making 450,000. And we're going to talk about 450,000 on a W-2, 450,000 in your LLC, 450,000 in your S Corp, 450,000 in capital gains, and 450,000 in passive income. I need you to understand the distinction in just taxes alone. Okay? So, my doctors and lawyers and, people, my professional people who are making good money got 450,000 on a W-2. You fall in a 35% tax bracket, meaning that you're going to have $52,832 in taxes off rip, and then you're going to have 35% on anything over $231,250. Just so you don't have to do the math, your taxes, I'm only speaking to the IRS right now, okay? You still have state and local taxes too. But your IRS taxes on your $450,000 is $129,394. And I'm also talking to single individuals. Yes, married, yes, kids, all of those things have different, tax breaks for you. But we're talking $450,000 single. $129,000, almost $130,000 in federal taxes alone as a W-2 earner. So yeah, you making money. But you spending a whole bunch with Uncle Sam. Now let's go to our LLCs. You file a Schedule C on your tax return, and you have some deductions that you can deduct from your income that those W-2 earners can't. 2018, the Tax Cuts and Jobs Act, it cut out everything. So educational expenses, even if your job requires you to get this education to keep that job, IRS don't care about. Mileage, going back and forth to business meetings and all of that good stuff. Meals and entertainment for your W-2 income. None of that stuff. Uniform, shoes, union dues, none of that counts. They are no longer deductions. So you got $130,000 that you got to pay to the IRS. Boom. Done with the conversation. Going down to my LLC. My LLC, we have some deductions, right? You got some stuff that you can write off. You can write off supplies, subscriptions. You can write off my coaching program, continued education. You can write off accounting services, any other legal and professional services. You can write off if you paid a couple contractors here and there to help you out in that business. You have some things that you can write off. And I'm going to go out on a limb and just do the percentages for you and say you got $100,000 in expenses. So your net income on your LLC is $350,000 now. You have $119,770 in a tax bill. Almost $120,000. However, take note, we're already saving $10,000 by writing off the stuff that we probably had under that professional W-2 job, but we actually are able to expense it before assessing our taxes. So just going from W-2 to LLC, we save $10,000, okay? Now let's go to our S Corp. Our S Corp, one of the major benefits of S Corp is that you do not pay employment taxes or self-employment taxes on all of the pros of that business. So we just said that business had $100,000 in expenses. So that means that $350,000 not only fell within the top tax bracket, but it also had 15.3% in additional tax applied to it. Of course, we got QBI and we can deduct a couple dollars and all that good stuff, but I'm just using the layman's terms so that we can kind of understand just how you fall in taxes just based on how you're generated income. So, S Corp, they got that same 100,000 in deductions, right? They got those supplies, those dues and subscriptions. They have, the legal and professional services, the accounting. They got all of that. But they also are an employee of that company, right? And as an employee, especially if you are the only employee of that company, you need to be paying yourself at least 30% on a W-2 wage just to kind of keep the IRS off your back. Okay? So 30% of that $450, we get to write off. We get to write off the employment taxes on that 30%. We get to write off our insurance, our retirement plan. We get to match up to 25% of the earnings that we paid ourselves in employer match for that retirement plan. And now, just off of that, we have increased our deductions by $135,000 for our pay, $20,655 for our employment taxes. The employee match could be up to $33,750. You already deducted $22,500 that you put into your retirement. So we got over $50,000 going into our retirement right there that we can write off prior to assessing any taxes. And now we have our taxes. And of course, like I said, this is single. I'm not putting any extra stank on it. These are the deductions. If you are staying compliant with your S Corp, you're paying yourself properly, you've paid your employment taxes, your federal tax liability on that same $450,000 in your S Corp is going to be about $67,141. Let's back it up. My W-2 earners are almost at $130,000. My LLCs are at $120,000. Now my S Corp is at $67,000. Okay? Now, capital gains. And I'm going to keep it at $450, even though one of the huge benefits of capital gains is that you get to subtract your cost basis from that capital gain from the sale. Meaning, if you buy a stock for $10 and you sell it for $20, you get to subtract that $10 that you originally paid for. If you buy a house for $100,000, you put $50,000 in it, and you had $10,000 in, closing fees and assessments and all of that good stuff. You can write off $160 of your sales price. So this is very different from any of the other incomes that we've talked about. But let's say $450,000. You made $450,000 in capital gains on 1 year. Let's just go on a limb and say, of course you probably paid something, but we're going to say you ain't paid nothing. You have no cost basis, $450,000. We have to pay capital gains on that whole thing. Well, your capital gains rate is about 15%. So your taxes, without subtracting the cost basis, which who is not going to subtract the cost basis, even if it's just a market price, depending on how you got that property or that asset, you're at $71,000. So again, if you, going back to the beginning, W-2 earners who working their butts off, any W-2 earner making $450,000 is losing sleep. Okay, they are working their tails off and they're spending $130,000 in just federal taxes. Capital gains, they bought a couple houses, they flipped them in a couple years, $70,000. Right off the bat, that's $60,000 in your pocket just for having a different type of income. And now let's trickle on down to some passive income. Now, passive income has a bunch of, thresholds and phase out rules and all of that good stuff. But I just want to keep it simple. If $450,000 you made while you were sleeping, right? You still get to deduct any of the expenses of that business running, okay? So if, you had to pay for the shipping of your book, or you had to pay for it to get printed because you sold more, or any of that stuff, you still get to deduct. So let's go back to the deductions of the LLC and the S Corp. Let's put it at $100,000. You deduct $100,000 from that $450,000, and then you pay taxes on it. And the number one thing that you avoid is the employment taxes. So I had to go through that breakdown like that, just so you know that $450,000 across all types of income are not treated equally. Okay? So now what the rich do, they have equity stakes in multiple businesses. They, at most may be a consultant or do speaking engagements or something like that. But a lot of that can go into content creation. It can go into advertising for the business. So they can write off a lot of their travel and their outfits and all of that good stuff from those speaking engagements. But their equity and them having money in different investment vehicles, especially like stocks and things of that nature, they're paying capital gains tax rates, which for most people is around 15%. They are not paying any employment taxes, so that 15.3% on all of their earnings is just out the window. And they have started to create revenue vehicles that make money continuously and continuously and continuously over and over and over while they sleep. So, going back to our good friend, we can go all the way, we can go back to Mitt Romney, but Donald Trump, who stays in the news, we always want to know why doesn't he pay taxes? Well, all types of income are not created equally. And that man ain't getting millions of dollars on no W-2. He's getting dividend payouts from his companies. He has so much real estate that is depreciating over 39 and a half years for commercial properties, 27 and a half for residential. There are so many things that you can get in place at any income level. It's just how you play it. It's how you properly plan for it. You guys, we are too stuck on, we got to make the money, we got to make the money, we got to make the money, instead of figuring out how to make the money work for us. So at the end of the day, understanding taxes, understanding the amount of taxes that you will pay at the different income levels in the different types of income, it is one of the most important things that you can do in business. In business, if you are trying to grow, which essentially everybody is, right? We make growth strategies in conjunction with tax planning. You can't do one without the other. So just right off the bat, going from a W-2 just to my S Corp owners, right? What was that? That was a difference of about $60,000 in federal taxes. I'm going to say this for the people in the back, just in case you just got on with me. The three types of income can be diversified on so many different levels. And when we talk about multiple streams of income, this is what we are talking about. We are not talking about, sell t-shirts and sell cupcakes. We're not talking about offer accounting and do some marketing. No, we are talking about having your earnings for your business that is in an S Corp and taking that election. We are talking about investment properties and assets and stocks and things of that nature. And we're also talking about some passive income. Maybe it's a product that you develop for my cosmetologist. Maybe it is a software that you develop for my realtors or people that need some type of algorithm to figure out things. Whatever the case may be, you develop it and you put the money into it so you can write it off. But then you allow it to continuously make money for you. Get paid and you pay less in taxes. So How the rich avoid taxes? They got them a Jenni, a tax BFF. They're not playing around and willy-nilly just trying to make more money. They are actually going into this and making strategic plans on generating more revenue in conjunction with saving on taxes, avoiding taxes, redistributing taxes, carry forward, all that good stuff, right? And those are the types of things that as business owners at any level, we need to stay abreast to. So today's lesson was don't give the IRS all of your money. But it was also just to introduce myself to new audience, new followers, kind of piggyback on the post that you guys really liked a lot, talking about Robert Kiyosaki and how he was just kind of explaining how you will never tax the rich because they don't do things like that. Let's take a deep dive into it. Let's really successfully create a strategic plan for you to grow your business while saving you money in conjunction. So say, you got a 2% growth rate year over year. When I get to the tax savings and also redistribute how you are writing off your deductions, meaning putting money into your retirement, putting money into investment vehicles and writing it off, then you will see that growth rate far exceeds what the revenue says. Definitely, I want to talk to you guys. DM me. Let's chat offline. You got to get into it. Business coaching can be the single most thing that takes your business to the next level because you have the idea, you have the talent, you are an expert, but you just don't know how to run it. And knowing how to hire, when to hire, how to pay yourself, when to pay yourself, these little things. If you should be having a brick and mortar, if you should expand, how to strategically get ready to have multiple locations. All of those things need to be done hand in hand by looking at the data that you've already generated from years in business, but also taking a look at trends from the rich. So I'm going to stop there. I am so glad that you guys found some value in here, and I hope that you stick around and let's talk more. Let me know what you want to talk about next. Have a great day.